If you're looking to purchase a home, whether it's your first one, you're upsizing, you're downsizing, or maybe it's an investment property, there's a few mistakes that you want to make sure you avoid. And the good news for you is that in this video, I'm going to be covering the most common mistakes made when purchasing a home. And they're coming at you right after this. What's going on, guys? Alex Dunbar here from the Dunbar Real Estate Group and RE/MAX Treeline Realty based out of the Surrey-Langley area. And in this video, I'm going to be covering the most common mistakes made when purchasing a home. And if you're new to the channel, I make weekly videos based on the BC real estate market as well as showcase community tours of the Lower Mainland. So if that's something you're interested in seeing more of, I suggest you subscribe to my channel and hit the bell so you're notified whenever I come out with a new video. And before I get into it, I'll ask that you do one thing for me, and that's to hit the like button so that the algorithm will push this video out to more individuals just like yourself so they can learn more about BC real estate. But let's not waste any more time and we'll get right into it. Mistake number one is starting the process too late. Now, this doesn't mean that you have to go out and get pre-approved by a mortgage broker immediately, but you should be having these conversations with your financial advisor, with your mortgage broker, with your real estate agent, and anyone else that's going to be part of the process earlier rather than later. You need to be taking a proactive approach rather than a reactive approach. What I mean by this is you need to figure out if there's anything you could be doing right now to put yourself in a better position in the future when you're actually going to buy. These are things such as making sure that your credit score is at a good level, not making any major purchases that may hurt you down the road, such as financing a car, and other things such as if you're going to be changing jobs. Additionally, you just want to be educating yourself early so that you know certain things such as what's going to be required in terms of a down payment, as well as what you're probably going to be able to get qualified for at that later date. Now, moving on to mistake number two, and that's searching for a home before you get pre-approved. So this is when it's actually come time that you're going to be out searching for that home and you actually need to go get pre-approved from a mortgage broker or a bank before you start looking at homes. The reason being is you don't actually know what you can afford without doing so. You need to figure out what your affordability is and thus what your budget is before you start home shopping. The example I like to give people is you wouldn't go on a road trip without checking your gas tank, so you also wouldn't go shopping for homes without getting pre-approved. Additionally, if you're working in a very competitive market, you're going to want to be able to act quick. And if you don't know what your actual affordability is, this isn't going to put you in as good of a position if you know exactly what you can afford. Plus, if you've already given all your documents into the mortgage broker or the bank, they're going to be able to get that approval much faster once you've got an accepted offer. And this means you can potentially have shorter subject removal dates, which is going to make you more competitive in a multiple offer situation. Moving on to mistake number three, and that's waiting until you have a 20% down payment. Now, depending on the price of the properties you're looking to buy, this can play a factor. The reason being is that the minimum down payment is 5% for anything under $500,000, between 5 and 10% for anything between $500,000 and $1 million, and at very minimum 20% for anything over $1 million. So if you're looking to purchase something that's over $1 million, this doesn't really apply to you. But typically, if you're looking to get into the market in a condo or a townhome, then a lot of people think that it's better to wait and actually save up that 20% so that they don't have to pay mortgage insurance. However, historically, what we've seen time and time again is that the market appreciates at a faster rate than individuals can save. So this means that during that time period that you were trying to save the additional money to hit that 20% down payment, you're losing out on appreciation and equity in the home. Now, this is going to depend on your unique situation and at what rate you can save. So this is a conversation you're going to want to have with your realtor and mortgage broker. But in most cases, it doesn't make sense to wait. Moving on to mistake number four, and that is trying to time the market. What you need to keep in mind is that the real estate market moves up and down upward. What I mean by this is that there's peaks and valleys, it moves up and down, but over the long run, it always trends upwards. So you need to stop focusing on these minor fluctuations of going up and down and start thinking about the long term. If we could actually accurately predict the market and when the ups and when the downs would be, there'd be a lot more rich people in this world. But even looking at someone like Warren Buffett, he can't time the stock market, and the same goes for the real estate market. What you need to think about is that it's about time in the market and not timing the market. Now, the best way to do this is to always have a 5-year approach. Never think about purchasing a property on a shorter time frame than 5 years, or at the very least 3 years. If the market does go up substantially over a shorter period of time, you just think of it like a bonus. But you should never be planning to just flip a property in a 1 or 2 year time horizon. It's when you do things like this that you can put yourself at risk. And on the flip side of the coin, if the market is to go down in the short term, as long as you're playing the long game, you're gonna be fine. Again, historically, over a 5-year time period, period, you really mitigate your risk of losing any value of your property. So the key thing to keep in mind here is just taking a long-term approach. And moving on to mistake number 5, this is mistakes when it comes to mortgages. Now, quick disclaimer here, I am not a mortgage broker myself, so please seek professional advice. However, I want to give you a few tips from my own perspective. Number 1 is that people go to their bank and not a mortgage broker. I have a whole nother video that focuses on just this topic, which you can find right here. But my quick 2 cents is that the bank's only going to be able to promote their own products. Additionally, a lot of the people that you work with at the bank aren't specialized in mortgages. They're typically doing other things like investments and RRSPs. Additionally, the level of communication just isn't the same. Most of the time, the bank's going to be 9 to 5 and you're not going to be able to get in contact with them after hours. The difference with a mortgage broker is they're technically 24/7 within reason, so if you need a response, especially at an urgent time, you're typically able to get that. Secondly, people get too focused on the rate. What I mean by this is all they care about is getting the lowest interest rate possible. Now, the issue here is that they're taking a very short-term approach, and oftentimes when you get the very lowest rate, there's hidden penalties and fees that you may not be aware of. So whoever you are working with, whether it's the bank or a mortgage broker, make sure they're educating you and letting you know about all the fine print. Most of the time, saving on that extra 1/10 of a percentage isn't really worth it in the long run. And this will become more apparent when you look at the total cost, but that's something we can touch on at a later date. And lastly is only focusing on a fixed rate and not a variable rate. Many people like going with the fixed rate because it gives them peace of mind that their rate isn't going to change. Now, I can empathize with this and I understand where you're coming from, but you really need to weigh the pros and cons of each. Historically, going with a variable rate is going to save you more money in the long run. Now, this is for a couple of reasons, and again, I don't want to get too much into it, but one thing you have to be made aware of is that if you break a fixed rate mortgage, the penalties are extremely high. More often than not, probably 10 times higher than that of a variable rate. But at the end of the day, this is a conversation you need to have with whoever you're working with in terms of financing. But hopefully I've at least given you some guidance on what questions you should be asking. And now on to mistake number 6 is having unrealistic expectations. A lot of people are waiting for that perfect home at that perfect moment. They're looking for that 10 out of 10 stunner and won't make any compromises. The issue with this is that it rarely comes up. The way that I like to work with my clients is we look at homes on a scale of 1 to 10. Anything that falls between a 1 and a 6, we pretty much just write off. As for homes that are a 7, an 8, or a 9, these are the ones that we consider. And that perfect property, that 10 out of 10, we call that the purple unicorn. The reason being is typically it either doesn't exist or it doesn't exist at your price point or in the location that you're looking for. Now, this isn't to say that they absolutely never come up, but unfortunately, for the most part, it's pretty rare. So what you need to do is figure out what your negotiables are and your non-negotiables. Make yourself a chart, put the pros and cons on either side, and figure out what you can live without. I've seen this time and time again where people continue to look for that perfect property and wait months or even years and end up missing out on building tons of equity. And if they had just purchased something that met almost all their criteria but just missed a few different checkboxes, they could be upgrading to that ideal home at this point in time. So again, just don't get too hung up on the little thing. Moving on to mistake number 7, and that's only looking at turnkey properties. This kind of ties into the last mistake as people get really hung up on finding that perfect property, whereas for most, it actually makes more sense to look for something that you can make some adjustments and renovations to make it suit your needs. So what I want you to focus on is things that can't be changed. These are things such as the location, the size, and the layout. And obviously the layout can be changed to an extent, but it can only be altered so much. You need to try and look past the smaller issues, the aesthetic stuff that can be fixed easily. This could be things such as the paint or the flooring. Additionally, don't get caught up on the staging in a property. That's the whole point why realtors do stage properties, because it makes them more appealing to buyers. But what you have to remember is that you're buying the vacant property. None of the furniture or staging items are going to be there when you move in. So try not to get hung up on things like this. Additionally, looking at it in terms of an investment, the real money is actually made when you purchase a property, not when you sell it. What I mean by this is if there's room to renovate and improve the property, it's going to sell for more at a later date. We like to call this sweat equity. Essentially, it means that the work and time that you're putting into the property and doing the renovations is actually going to pay off more later on. You're also probably going to be up against less competition than a turnkey property. And at the end of the day, a lot of these properties you can renovate and change to exactly how you want it. So keep this in mind when you're home shopping. And lastly, mistake number 8 is getting too attached to the listing price and not the market value. What you have to understand is that a listing price is only a marketing strategy. For example, over the past year or so, many agents and sellers have been listing a property low in order to drive more traffic and multiple offers and hopefully receive a subject free offer. Of course, the lower the price, the more buyers it's going to attract. But as I said, The price it's listed at really doesn't matter, it's the price that it's going to sell for. So what you need to do is get your agent to pull up comparable sales in the area to see what its actual value is. And don't kid yourself, this can also work in the opposite direction. In slower markets, sellers often list high so that they have room to negotiate. And from a buyer's perspective, a lot of them feel like they're getting a better deal just because they're paying under list price. But again, at the end of the day, it really just comes down to what the actual market value is based on comparable sales. The key here is to take as objective approach as possible. I know this is difficult at times because the buying process is very emotional. However, that's why your agent's there. They should be able to provide you with guidance and have a level head even when times get tough. But at the end of the day, paying over asking or under asking is kind of irrelevant. And that's about gonna wrap it up for my video today, but if you did stick around right till the end, I have one more bonus tip for you. And that is to avoid the mistake of only looking at new listings. So what I mean by this is when a new listing hits the market, that's typically the first time you're gonna see it, and you're not often gonna look at it afterwards. However, many times those listings come up and they either have no pictures, poor pictures, or just poor marketing in general. And when you're consistently filtering through dozens of different listings, you're not often gonna give it a second look. And everyone else looking for similar properties is probably doing the same thing. So what I want you to start doing is looking for listings that have been on the market for 10 to 15 days or longer. This is where a lot of people miss out on some hidden gems. And by looking for these listings that have been on the market for around 2 weeks or longer, it's going to provide you with more opportunities and less competition. But there you go, there you have it. Those are the most common mistakes you need to avoid when looking to purchase a home. So I hope you got some value out of today's video, and if you did, I'll ask that you do one thing for me, and that's to hit that like button. And if you are interested in seeing more videos just like this one, I suggest you subscribe to my channel and hit the bell so you're notified whenever I put out a new video. Additionally, if you are looking to buy or sell in Surrey, Langley, or anywhere else in the rest of the Lower Mainland, you can scroll down and book a call with me to discuss your options at your earliest convenience. Thanks so much for watching, and we'll see you in the next video.